So what's the big takeaway? Economists expect the Consumer Price Index, or CPI, to show that inflation climbed about 3.1% compared to last year. That's the fastest pace we've seen since May 2024. Core inflation, which excludes food and energy prices, is also expected to remain steady at around 3.1%. These numbers suggest that price pressures haven't eased much, and everyday Americans are still feeling the pinch. Whether it's at the grocery store, the gas pump, or when paying for basic services, this is exactly the kind of sticky inflation that makes life more expensive and forces the Fed to tread carefully when making policy changes. Part of the problem, analysts say, comes from tariffs, a major factor that's driving up prices across a wide range of goods. The effective tariff rate has climbed to around 18%, the highest level seen since the 1930s. That's making imports like furniture, clothing, and food costlier for consumers. Some companies had stocked up on products before the tariffs took effect, but those inventories are running low, which means shoppers may start feeling the full impact soon. Interestingly, while prices for cars and electronics have been relatively stable, services like travel, auto repair, and personal care continue to rise, putting even more strain on household budgets. This puts the Federal Reserve in a very tight spot. The central bank has been working to balance two goals: supporting a labor market that's losing momentum and keeping inflation under control. With hiring slowing and wages flattening, many experts believe the Fed will likely cut interest rates by 1/4 point at its upcoming meeting. That would bring borrowing costs down to between 3.75 and 4%. But the Fed's challenge is clear. Move too fast on rate cuts, and inflation could heat up again. Move too slow, and it risks stalling the economy. Making the right call is even harder right now, since the government shutdown has disrupted the release of key economic data the Fed usually relies on. At the end of the day, this inflation report tells a complicated story. Yes, inflation seems to be cooling compared to last year's highs, but it's still far from the Fed's 2% target. Everyday costs remain high, and while the central bank is trying to stabilize things, there's no quick fix in sight. Economists say the coming months will be critical. The Fed will need to read every signal carefully before deciding how aggressively to act. For now, consumers should expect prices to stay elevated, even as interest rates start to ease slightly. One thing's for sure. This latest report makes it clear that America's battle with inflation isn't over yet. It's just entering a new phase. Hey everyone, welcome back to the channel. Big news this morning. The long-delayed U.S. inflation report for September is finally out, and it's sending some serious signals about where the economy might be headed next. After being pushed back because of the government shutdown, this report could reveal just how sticky inflation really is, meaning prices aren't falling as quickly as consumers or policymakers hoped. Analysts are already watching closely, especially with the Federal Reserve preparing to meet next week to decide whether to cut interest rates again. This new data may not just influence that decision, it could shape the direction of the entire economy heading into the end of the year.